Good afternoon, this is Ken Long from Tortoise Capital with a review of some frog system case studies. That's our intraday low information required trading strategy. These are samples from our live chat room from January 2014. What I want you to notice on this chart of the last 4 months of dailies in symbol SPY, just how many large range days are available. This is a market that's been bull quiet, but still you'll notice I'm highlighting a lot of large range red candles against the trend. In addition, there have been quite a few days that are very directional intraday featuring a large range and a large real body. Those are the kinds of days that the frog system really is going to do well, because it takes advantage of the intraday trend in a very disciplined manner. Now, this is an example from January 14th, 2014. The symbol is XIV, the inverse volatility ETF. It's a QF, meaning quick frog, meaning that we're going to wait 30 minutes into the trading day before we make our move. What you need to know about this strategy is that we compute daily a frog standard deviation number that measures the normal variation of daily ranges and gives us a measure to distinguish between signal and noise. It's the quick frog because we're going to wait 30 minutes before we take action. If it was the slow frog, we'd wait 60 minutes to take action. If it was the leap frog, we would enter the market as soon as it has made one noise unit in a particular direction. We would go in that direction. And so this was the opening of the day, and then these are 1 minute charts. So 30 minutes into the day, marked off by this line here, we have the market has moved 1/2 of a standard deviation off of its low of the day. And so we're using a variation of the quick frog here, where at 30 minutes, if it is moving in a particular direction and has moved at least half a standard deviation away from the low, we can go long. Now, this lines up at 30 minutes with our regression line crossover system really well. I'm not going to talk about that one, but you can see at this point as price is leaving the central Bollinger Band, that's one of our signals. So we had the intersection of two strong signals here. So we make an entry at 35.24. Your choices for stops on this one are either a 30-cent initial followed by a trail, which would give you this dotted line, which would get you into the money pretty quickly, or if you use a 60-cent, also a trailing stop, and that would get you into the money after about an hour. And so this was the setup. Gets well started, and off she goes. Later on that day, now we're looking up at 3 minute charts just to give you a wider range. Here was the open, here was 30 minutes in. This was the entry moment at 35.24. If you use the 30-cent trailing stop, you get this dotted line as a stop, and when price and the Bollinger Bands come back to meet the stop, you get an exit at 35.80. If you had used the 60-cent trailing stop, you get this line, and again it's going to exit up in here when price has re-entered the river, and you either have a 1.9 R on the 30-cent stop, or about 1 R if you had used the regular line. Very mechanical system, quick frog entry, and that's how we do that. The next one is showing also XIV. This is our opening. This is that 60-cent frog style standard deviation. This was the opening. At 30 minutes in, price had only moved 1/2 of a frog off the low. You could make a speculative entry here after a 1/2 standard deviation move up, trailed by either a full or a half. If you were waiting for a full standard deviation move, you couldn't enter until it had breached this green line. So at 30 minutes, there's no decision, or you make a speculative entry. If you're using the formal rules, you end up waiting, and about 45 minutes in, it has now moved 1 full standard deviation off the low, and this would be where the mechanical quick frog and leap frog could enter. And so you get an entry at about 35.56. The slow frog entry happened shortly thereafter at an hour in, also at about 35.56. If you use this as the 1 hour trailing stop. You get this red line for a stop. It's never seriously breached, and then 30 minutes before the exit, we take the exit up here at 35.91, which would give you about half of an hour. Now, for those of you that are not mechanical traders, there are a number of places where your psychology would have been stressed after almost an hour in hand. This pullback at this point, with almost an hour in hand on the speculative entry, and with the price hovering right at this resistance level for most of the day, you might have elected to take exits here or here. If you hold on and follow the rules, you get a pretty good exit in this case, and that's what the frog looks like. Waits for a non-noise move in a particular direction, enters with a non-noise trailing stop, and then exiting not later than 30 minutes before the close. We also use the frog as a way to estimate the difference between signal and noise. This was a trade in the VIX, and after an extremely vigorous move down, which we captured with a frog on XIV, we settled into a very tight sideways quiet channel. I bracket the median or the mean with a frog box, in this case frog standard deviation of 80 cents, and I was ready to go long at 41.20 or short at 40.40. In other words, to not get chopped around by the intraday quietude, recognizing that if it can move up to 42.5 very easily intraday, given the volatile nature of the VIX. So this is a case of adapting the frog standard deviation measure to improve our trade framing and not get whipsawed. What that looks like on a little wider scale, the same trade, this is that sideways quiet channel. We use a computation and an indicator called the range statistic, which gives us a way to estimate the maximum reasonable intraday move. In this case, we were looking for a return to the previous day's high, and so we hang a range stat at the current day low. And then we know that it is not unreasonable for the VIX to move that far intraday, and that would set up a nice reward to risk ratio trade. So if it had broken above the purple line, which is the VWAP, or from the previous chart, if it had breached this standard deviation line here at 41.20, that would have given us an entry about 41.20 with a stop below the low of the day, and given us easily by inspection a 2 or 3 to 1 reward to risk intraday. Even on a retest of the morning opening, we could have pocketed a nice gain, and then if it closes the gap, we get a nice gain to 42.30. So we use the frog standard deviation, the frog rule sets, both as a means of mechanically trading the markets, understanding a mathematically computed difference between signal and noise, and we also can use that as a consistent, adaptive, discipline measure to frame reward to risk ratio trades if we see something that looks to be tradable based on market price action. So that's Ken Long from Tortoise Capital. Appreciate your attention. Keep your risk measured and your powder dry.